Good morning. Welcome to today's webinar entitled Silver Investments Webinar, presented by the Silver Institute. Your program will begin shortly. To view the presentation in full screen mode, click the F11 button on your keyboard. In the lower right of your screen, you will find the Action Center. If you have any questions for the presenter during the webinar, you can submit them by using the Question and Answers tab. If you experience technical difficulties, contact support by clicking on Technical Support tab in the Action Center or call 1-877-992-7225. Again, that phone number is 1-877-992-7225. If you are disconnected from the webinar, you can re-enter the program by using your meeting URL provided to you and the email address you used to register. At this time, I would like to introduce our moderator for today's program. Today's moderator is Michael DiRenzo. He is currently Executive Director at the Silver Institute. Good morning, Michael. The floor is yours.
Thank you. Good day and hello, everyone. Welcome to the Silver Institute's Silver Investment Webinar. I'm Michael DiRenzo, the Executive Director of the Silver Institute, and I will be your moderator during today's one-hour event. We appreciate you being with us. This webinar will examine the current drivers affecting silver investment and what potentially lies ahead for the white metal. Silver investment has been on the rise the last several years as more investors recognize the metal's intrinsic worth and include it in their portfolios to diversify their holdings. There are many options for silver investors. Silver-backed exchange-traded products offer the investor a convenient means to gain exposure to the day-to-day movement of the price of silver. Mining company stocks can offer capital appreciation and the potential to earn a dividend, while physical silver appeals to some investors because it can be kept close at hand or stored by a custodian. Most recently, the hashtag Silver Squeeze appears to have established a new generation of silver investors who have collectively harnessed the power of social media to acquire silver in all forms and are still active today. That brings us to this webinar. We are privileged to be joined by a distinguished panel of precious metals analysts who will share their insight into silver investment and the current state of the market and what may lay ahead. These gentlemen are well suited to help us better understand the current economic environment, the geopolitical undertones, and market forces that are shaping silver's prospects. Our panelists include Bart Melek, Global Head of Commodities Strategy at TD Securities. Bart has over 20 years experience analyzing precious metals, base metals, energy, financial markets, and global economies. Also joining us is James Steele, Chief Precious Metals Analyst at HSBC Securities. Previously, Jim ran the New York Research Department for REFCO, a U.S. commodities brokerage house. Earlier, James worked for The Economist in its intelligence unit, covering commodity-producing nations. Rounding out our panel is Michael Widmer, Commodities Strategist at Bank of America Securities, where he leads the research coverage and mine commodities at BofA Securities. Michael joined BofA from BNP Paribas, where he had been senior metals strategist. Before BNP, he was head of metals research at Lehman Brothers. All three of our panelists are frequently sought after by the financial media for insight into the precious metals and financial markets. They can be seen on business television networks such as CNBC and Bloomberg, and in print and leading news publications. Today's webinar will be a conversation with the panelists, where I will ask them their thoughts on various aspects of silver investment. Our panelists will be pleased to take your questions in the final 15 minutes of the webinar. To submit a question, click on the question mark icon at the bottom of the screen and type that question. You can do this at any time during the webinar. I will then pose the question to our panelists, and we hope to get to all questions, time permitting. Before we begin, I would like to draw your attention to the following disclaimers from TD Securities, HSBC Securities, and Bank of America Securities. I will add that the information discussed today is not to be construed as a solicitation or an offer to buy or sell silver or related products, securities or related investments, and nor does it constitute advice in relation to the buying or selling of the same. You must obtain professional or specialist investment advice before taking or refraining from any action related to the content of this webinar. With that, I would like to welcome our panelists. Let's begin the discussion. Bart, first question goes to you. Are silver ETF holdings and investment flows important price determinants for silver?
I think certainly they are. The history of them has been that as silver has performed well, we've seen a constant and steady accumulation of the amount of silver being held in those ETFs. So I think they are. Ultimately, I'm not sure that they are the primary drivers. Quite often, silver is driven by gold, monetary conditions, real interest rates, but it's a combination. And then, you have investors get interested, they start buying up silver, that stresses the rest of the market. But I think more importantly, they have been almost a protector of silver. Even when silver had its corrections after robust rallies, we've not seen en masse exodus of investors from the ETFs. So they have actually been a fairly stabilizing force. Maybe on the upside, they're not the biggest driver, but I think they provide some stability these days as investors continue to hold it, even if prices have corrected. We've seen some exit, but not as elastic as I think one might have imagined. So yes, I guess that is the answer.
Any other thoughts there, Michael or James?
Well, I would, first of all, Michael, thank you very much for your gracious invitation, and thanks to everybody in the audience for tuning in. I would echo and reaffirm what Bart said. I mean, we've looked at, for example, just to compare it to gold, we've looked at there's a very strong price relationship between ETF flows and the gold price, whereas that does not appear, if you follow the same statistical reasoning, to be the case with silver. That's not to say that it's not influencing the silver price, but I think Bart's point about we haven't seen the exodus in silver ETFs the way we frequently do in gold as absolutely key. And I see it more, like agreeing with Bart, I see it more as firming the undercarriage for gold than for silver, excuse me, than necessarily driving it than driving it higher. And just because we can't detect the statistical relationship, that's not to say that's not supportive.
No, I would agree with that. I think overall, when you're looking at the physically backed ETFs in gold, but also in silver, I mean, on the gold market essentially is investor driven, right? So all investor products do certainly matter. Actually, in the gold market, we have seen that the physically backed ETFs have absorbed a lot of liquidity from the market. We did see that in very reasonable distortions in some of the physical markets last year. On the silver market, we haven't really seen that to the same extent, and I think that's also partly influenced by kind of the breakdown of silver demand and what drives silver demands. You do have a very large or larger industrial component on the silver market that you don't necessarily have in say on the gold market, and that really, I think, means that while ETFs are important, you also rely on what industrial users are doing.
Thank you. Michael, question for you. Silver is often seen as driven by macro events, with prices declining initially in the wake of the recent FOMC decision. Is macro really the driver that influences prices on a sustained basis?
That is an interesting question. I think it basically picks up on my previous comments. I think commodities generally are all macro-driven assets, right? I think you are embedded in the wider global economic picture, and that determines ultimately whether prices go up and down. When I look at shorter-term price movements, clearly, I think silver, similar to gold, can be influenced by rates. Real rates can be influenced by the US dollar as well, as we've seen in the wake of the FOMC decisions. But I would also say that if you take a kind of a longer-term, bigger picture view, it is very hard, I think, for macro to push prices one way or other standalone. You've seen that in recent years when silver prices was trading around $15 per ounce on very idiosyncratic weak fundamentals. So again, macro matters. I think what happens in the markets matters, but you also have that physical overlay that ultimately determines whether prices can be high on a sustained basis or not.
Thank you. James, what do you see as the major driver of silver prices going forward? Investment or industrial demand, and in particular, what types?
Well, I think, you can compare it almost to a ship on the ocean. When you look down, the first 30 meters or so is a current going one way, and that can very well be investment. But below that, down to the ocean floor, there's the subcurrent, and that moves much more slowly. But that ultimately dictates the weather and the current as well. So I think you can make this distinction. Industrial demand is rather slow moving. Mine supply, although it's not on the demand side, of course, is slower moving. Investment is near term and quick. So you can look at investment and sometimes be almost fooled into thinking that changes or rapid changes in investment from one day or 1 week, 1 month to another is what's driving the gold price, the silver price. But ultimately, it is going to be the hardcore bedrock demand that is industrial. After all, 1/2 of or more of silver demand is industrially based. It's a very, very large component of demand, and 2/3 of that is electronic. Now, I think the marginal one, although electronic is the largest component, what seems to be the marginal industrial component seems to be solar power. That's the one that's grown the quickest in the last few years, and that's had the added input, I think. So ultimately, it's going to be medium to longer. The longer term you look, the more industrially and manufactured based you're going to see prices dictated. The shorter term you look, the more it's going to rest on investment flows.
Very good. Any comments from Bart or Michael?
Yeah, I'd just like to add to that. Certainly in the short run, and certainly has been the experience over the last 12 months, the investment component has been quite important in driving silver. And in many ways, it has been the investment flow into gold. There is a very strong relationship between gold and silver, at least in the short run for now, with the volatilities being about double silver. And when these flows into gold materialize, they tend to materialize in silver as well, except silver doesn't necessarily exit while prices move lower. And that component has been quite important to actually bringing, by our modeling, deficits in this market. And I think that has been very, very supportive. And the good news for silver is that as we move forward, investment holdings seem to be steady over time. And as demand moves higher, and we continue to have, I think, long-term constraints on supply growth, I think there will be upward pressure. I would not exclude the possibility that, in the long term, silver behaves very much like palladium has, very much marching to its own drumbeat of supply and demand. And I think with the global economy trying to decarbonize, silver increasingly will play a role, not only in solar power generation, but also in all the extra electronic components we will need as well, and new technology like G5, new ways of using silver as solder, which gets rid of heavy metals like lead. So I think things are looking very good. So I guess it's both are important, investment for the short run and industrial longer term.
Yeah, and just to say quickly, I mean, at the moment, and I think for the foreseeable future, silver is going to benefit from a sweet spot, both strong investment and industrial demand occurring at the same time. It doesn't happen often, but it's happening now.
And it's actually interesting when you're looking at the gold-silver ratio as well, how it has played out over the last kind of 12 to 18 months. That tells you really kind of when silver comes into its own. Obviously, gold-silver ratio collapsed or rose above 120 during the height of the first COVID wave, and that was a period also when manufacturing activity was quite easy. Obviously, I think gold was benefiting a lot from those dislocations at the time. Still, I think as the global economy started to open up, industrial activity very slowly started to recover. You did see that silver started to outperform gold actually by quite a meaningful margin. And now I think it's interesting with the fiscal stimulus, the various fiscal stimulus packages coming in, a lot of them having green components, having bricks and mortar in them. That I think is one reason why the gold-silver ratio is now below the levels where we were really before where we had been before the COVID crisis started to kick off. So I think when I look longer term out, longer term, the industrial side certainly matters, and I think it's the industrial side, the industrial demand, that ultimately should attract more investors. I think the non-commercial market participants don't really want to invest into a vacuum, and that vacuum is clearly well filled if we see more demand from the industrial side going forward.
Excellent. Bart, you good?
Yeah, I think I probably said all I'm going to say on that matter.
Very good. All right, Michael, question for you. Beyond macro, there has also been increased interest by investors in market balances, as fundamentals on the physical market that indicate a market surplus may not rally, even if macro is strong. How do you think the silver market is set up fundamentally?
Yeah, look, I'm very happy that you didn't invite me 10 years ago. I think the market then was set up very differently, but it has changed fundamentally. It has changed remarkably, materially over the past years, and it's really a few things that came together here. I think when you're looking at kind of the bear market that we had been for a while, for a long time, silver mine production actually continued to increase. It's only 2017, 2018 that miners started to cut actual production and haven't really looked back since. At the same time, I think that perennial drag that we did have from the photography industry started to tail off. And then I think Bart and James mentioned you had actual new applications like solar panels kicking in, absorbing some of those excess ounces. So even without investor demand, we actually did see that the silver market organically kind of has rebalanced over the last 3 to 4 years. So that was actually a key factor why a few quarters ago we called a bottom to silver prices, highlighting that the picture has structurally improved on the fundamental side. And I think that structural improvement is actually still with us. For all that we can see on the mining side, the miners, sure, they will increase production a little bit, but the project pipeline, as it is for many other commodities, is actually not particularly well filled. And you still have got demand from a whole range of new applications. Depending on how the kind of the green stimulus plans and on how quickly the decarbonization play out, I think you could end up with a silver market where, through demand, for instance, from solar panels, you have sustained deficits now going forward. So yes, fundamentally, I think the market looks quite good.
Excellent. Okay, this is a question for all. I'm going back to the ETF arena here for a second. 2020 saw over 1 billion ounces going into ETFs for the first time. Do you have any insight into how this year is looking in terms of global ETP demand? First Bart, then James, and then Michael.
Well, certainly it's been a little weaker here, and I think that has a lot to do with what has happened to gold and macro and monetary policy expectations. As you recall, at the beginning of the year, the Democratic Party ended up winning both Senate seats after the special election, and that essentially meant that now the Biden administration controlled both houses, the Senate and the House of Representatives, and that essentially meant to the market that we will see a lot more spending. The market reaction was to basically expect the Fed to react, and we've had, after gold peaked at $1,900 and silver did extremely well as well, we had a sell-off. So that's been a bit of a spanner in the works for silver. I think it comes back. Will it be as high as 2020? Probably not. But I think as we become comfortable with the idea, even after the last FOMC, that the Federal Reserve isn't about to tighten monetary conditions, I think the demand for precious metals as a hedge, as an investment, will continue. Real rates are still maybe not as low as they were a few weeks ago, but still in negative territory across the yield curve, and we should start seeing precious metals do well, and that will ultimately mean silver demand as well. And I think many investors are looking on that component, but also they're trying to project forward, and they know that the silver loadings in your average vehicle that now is full of electronics will be much, much more. And as we dedicate trillions, not only in America but across the world, to make the economy greener, certainly in the G7, that will mean we'll be utilizing the metal more intensively in auto building, in electricity, in switches, and of course I've already mentioned 5G. And there could be, knowing that that market is tightening up, you might want to take long-term positions ahead of time. And perhaps that is what explains the relative stability of ETF holdings, even when price goes to the downside for a bit. People, I think, are looking for the long term here.
James?
Well, yes, the ETFs have been a little weaker this year. I mean, looking at them specifically. However, they are a very convenient investment market. They have a high retail component. And as far as I can see, the retail reasons, or the reasons for retail investment, will remain firm this year. As Bart said, the negative real interest rates remain negative, not just in the US. We continue to have accommodative policy. Tapering is understood that it will occur. I think that's at least been partially digested by the market. And so the bar market is coming back a little bit, although there's been some weakness in Asia earlier. And I do think that as an investment vehicle, the ETFs are attractive both on an institutional and a retail reason. And the raison d'etre for investment in them remains good. Again, last year was absolutely exceptional, and that's always the problem in comparing year-on-year comparisons for anything. And when you're coming off of either a very weak base year or a very strong base year. So sure, some consolidation, maybe some give back for a while, wouldn't surprise me after hitting that billion-ounce level. But a longer term, for the medium to longer term, I think the ETFs will remain attractive.
Excellent.
Yeah, look, ETFs, I think we have a third of the inflows year to date, roughly, of what we had in the first half of last year. And to me, I think when I look back over the last kind of 12 months or so on the questions that we have been getting from clients and the modeling work that we did, I think there was a lot of focus at some stage pre-elections in the US also on Biden's, call it, manifesto and the decarbonization of the power sector in the US. So the question then revolved around, well, how many solar panels might be installed? What will maybe lower silver loadings in solar panels and the higher wattage mean for silver demand in an environment like that? Will the market be in surplus? Will the market be in deficit? And I think a lot of those questions still haven't really been answered. We have got a guide, probably. We know that decarbonization will coming, but I think from an investor perspective, seeing the actual implications is among the many factors that kind of have depressed maybe the inflows a little bit year to date as well. So I think getting better guidance on the fundamental and the physical side of the demand that is coming through from renewables, I think would certainly help inflows. But inflows, as James said, I think are not bad. They're just not as high as they were last year.
Yeah.
Very good. All right, switching gears here a bit, Michael. What threat are cryptocurrencies to precious metal investment, and in particular, silver investment?
It's an interesting discussion. Look, I think we get the question on the nexus between cryptocurrencies and particularly gold, but also precious metals a lot. The question that I always ask in return is, well, how many cryptocurrencies do you hold? How many gold do you actually hold in your portfolio? And I would say, in the majority of the cases, the people asking the questions, they do hold precious metals, but they don't necessarily hold the cryptocurrencies. I think the risk-return profile of cryptocurrencies is very different to the risk-return profile of precious metals. I think when you're looking at Bitcoin in recent months, to us, the prices have behaved more like a risky asset than kind of an asset that you can add, for instance, kind of as a portfolio, as you do it, for instance, this gold. Silver, again, has very different characters. It's kind of a mix between the two. So I think it's certainly, if you're looking at it from a currency perspective, like precious metals having been a currency once, cryptocurrencies trying to become a currency, that's probably the nexus that you have. But I think when you're starting to look a little bit closer, the risk-return profiles don't show a lot of similarities. So I think investors who add cryptocurrencies might not always have the same motivations than investors by adding precious metals to their portfolio.
Okay. Any other thoughts?
Just to add one quick thing. I mean, what is the raison d'etre to own silver? It's the physical component. It's the fact that you have it. You have it. It's no one else's debt. It's no one else's obligation. This is the whole element that makes precious metals so attractive. And that's not, and I'm not poo-pooing cryptocurrencies at all. I have no opinion on them. I'm just saying, as a juxtaposition against bullion, this is the difference.
Yes, I will add one more thing to your statement, James. They are precious metals, are physical, and they require real resources in forms of labor, capital, energy. Given some technological framework to get out of the ground, process, and make into bars or for storage or into industrial grade grains. But the interesting thing about precious metals, given their very close relationship to an actual production function, as inflation goes up, labor costs go up, and that's an input in producing silver, energy prices, and everything else. So that makes them almost, a perfect natural hedge. They will reflect what is happening in the real economy in terms of cost. And they've been around, I would add, for thousands and thousands of years. They're useful. we do things with them. Silver in particular has many extremely productive uses for society, ranging from industrial to pharmaceutical use to catalysts, you name it. And I'm not so sure we'll ever see regulations outlawing silver. I'm not as certain those regulations will be so favorable to old cryptocurrencies as well.
Okay, great. Good answer, gentlemen. Bart, question for you. Given its traditional relationship, will silver out or underperform gold once real rates and monetary policy turns restrictive?
Well, typically what has happened is when there is a favorable precious metals environment, gold does well and silver tends to do better. The average volatility and the implied volatilities on the options market is 2 to 1, give or take. So you can, I think, roughly say for every 1% increase in gold price, you will see silver outperform, by a factor of 2 to 1. It doesn't always happen that way, but I think if we're generalizing, that's what we can see. And this is why you will see the silver gold ratio. When things are looking grim, like we did about more than a year ago during the depth of the financial crisis, when silver fell to, I think, just over $11. Gold fell too, but that ratio exploded to, I think, 124. So silver underperformed. But now that we had massive quantitative easing, just a stellar industrial recovery, silver outperformed to the current ratio. Now, going forward, I think we will, lose that tie-in to precious metals. I'm not saying in the next year or so, but over the long run, as the industrial component becomes more and more important, as I think the supply side becomes a constraint for silver, owing to being, mined from secondary, not a lot of investment, I think there'll be a bit of decoupling. If gold slows down, it doesn't necessarily mean that silver demand will slow down to the same magnitude. Maybe there'll be a bit of a slowdown on the investment side, but the industrial side should make it a little bit better than before. So if gold goes down, X%, silver might, be flattish, at least in the immediate, because there's a very quick response function. These CTAs and other trend followers will just mindlessly sell or buy. But I think once we get over those shocks, I think silver does well, and I think silver outperforms.
Excellent. Any other thoughts, James, Michael?
It's the key. The key is industrial, just as Bart said and Michael referred to earlier. If you have a more restrictive monetary policy that is going to affect the investment side, but which has got a greater component for gold, say, than for silver, but the industrial side remains brisk, which appears to be likely, then silver will prices will become more a function of the continued industrial expansion, and therefore benefit from that, and not be as negatively impacted by restrictive monetary policy, as if, say, for example, industrial demand was neutral or weak.
It's actually a question that is coming up quite a lot now, is the Fed and other central banks actually starting to tighten monetary policy, I think. There's always this inherent concern that higher policy rates have to be bearish all commodities, and I can see how they increase volatility on some of the equity markets, but I think on the cyclical commodities specifically, an increase in rates or in real rates does mean that we normally have an acceleration in global economic activity, or strong global economic activity, and I think that's where we're in right now. And very simplistically, if you plot the gold-silver ratio against world industrial production, you actually get quite a good fit. So the period of reflation that we are in right now should, yes, absolutely help silver relative to gold going forward.
Excellent. Thank you. A reminder, those in the audience, feel free to submit your questions. We've got several more here for our panelists, but I'd like to take one from one of our audience members. They're interested in Bart and James's view of silver deficits over the remaining decade, and all three participants on new mine supply over the next decade. Bart?
Well, look, our modeling, when we include the investment component, are showing deficits. Certainly in 2020, 2021 into 22. Forecasting the long term is always difficult, because forecasting, particularly the future, is hard. But when I look at the demand side, all the new sources of demand, the amazing amount of, dizzying amount of fiscal policy, and extremely accommodative monetary policy, I conclude that the demand side globally, aggregate demand, should do well, and industrial demand should do well as well. We will have, your temporary slowdowns, but that's to be expected. And I think so. Trend demand for silver should be quite good, driven by the industrial component, which it will be very much driven by monetary accommodation and fiscal. And we're not done with fiscal in the US, for example. And there'll be more around the world as well to get us out of this COVID, make sure there is no scarring on the economy. The Fed will have a full employment policy, and I think the rest of the G7 will make similar policy. So the demand side should look robust. When we look at the supply side of the equation, well, things aren't all that robust at all. We should note that vast majority of silver comes from secondary sources, meaning, either byproduct of copper production, zinc, lead, gold, and there we're seeing very little investment. Markets are not ready, and boards of directors for major mining firms and investors as well are not ready to commit funds to grow supply. I think there's a lot of worry that we're seeing high prices today, but they may not hold. We're seeing a lot of volatility, and really there is no effective way of hedging these prices. So I think we will get deficits, and that will apply price pressure on silver, which ultimately should generate new investment activity. But we should keep in mind that the supply side of silver, the mining side in particular, is very price inelastic. It takes a long time, meaning you can have a big price rally, but it can take many years, 7-10 years, before you get an additional incremental ounce out of the ground. So it's when if demand does spike up, it's going to be difficult to see where that silver comes from. It's going to have to come from inventory for now.
James?
Well, we're looking for a deficit this year and a more balanced market next year. Now, going forward further into the next decade, deficits could very well resurface. But it depends on how you look at the supply-demand tables and what you're including and what you're not. I mean, we're still looking for strong ETF demand, but on the and we're reasonably positive on mine supply, at least in the near term. Longer term, there are the issues that Bart made up, surely. But it's also important to make a distinction as, technically, and I don't want to get too technical, but there's often no such thing as a deficit, because the silver and the demand and in any commodity, because the demand will meet the supply, or the supply will meet the demand one way or the other. And so what you're going to see, and Bart touched on it, is a drawdown in stocks to meet any deficit. And that is where I think those who might be worried about rampant price rises due to very big structural supply-demand deficits can relax a little bit. There is a decent amount of silver above ground. COMEX stocks have come down, that's true, but there's still several 100 million ounces there. There's the to quote Donald Rumsfeld, paraphrase him, there are stocks we know about and there are stocks we don't know about. And I'd be pretty sure that the ones we do know about are at least 1.5 times current demand. And that's what we saw when the market bounded up to $50. We saw a boost in recycling and a boost in and rapid drawdown in some of the above ground inventory. So it's not to say that the price won't rise, and I agree with Bart on that, but the demand can theoretically at least be met.
Michael, if I can just add something to my
Sure.
to the comments I made actually earlier on that. So when I look at the mine supply side, I think we came up with just over 25,000 tons of silver supply in 2020. We have that rising to 26,400 this year. And then by 2024, have it just over 27. Now, to put those numbers into context, before we saw the miners actually cut production in kind of 2016, 2017, we were just above 27,700 tons. So in effect, on the mining side, the investment that the limited investment that we do see come through just about gets us back potentially to the overall supply figures that we had pre cutbacks. I think on the demand side, look, ultimately the key demand drivers, the marginal demand drivers going forward are sexy new applications. Take solar panels, for instance. I think that is one big data was. If I model demand from solar panels going forward, just on the assumption that the world needs to install more generation capacity, and yes, we're losing a little bit of silver content, we get higher wattage. You can certainly justify a silver market, and I agree with James that looks a little bit better supply 2022, 2023. Now, the interesting bit though is if you do get, if you model, for instance, Biden's plan to have a zero emissions power sector in not even 15 years time, then the picture starts looking quite different, because not only do countries like the US have to invest in higher power generation capacity, but they also have to rejig currently existing. They also rejig the current grid. And if you start looking into those numbers, the silver market actually does look very, very strong. I think we have got deficits out until 2025 effectively. And I think this is why the second half of the year to me looks really quite interesting, and particularly the kind of the COP summit later this year. I think if there's more of a global understanding that there is a need to decarbonize the economy, that there is a need to tackle climate change on a more sustained basis. The recent G7 statement signaled that developed countries are willing to make the transition easier for emerging markets. I think if all of that comes together, you could see quite strong support for the silver market. And that's also why I said early on, I think what is holding silver back a little bit, in my view, is exactly that we have got a feeling that tackling climate change becomes more of an issue. But I think having a better picture would certainly help. And look, infrastructure package in the US, I think has been chewed over a few times, has been voted down, might not get signed off until later this year, if at all, right? So this is, I think, this is to me still a key determinant to the market. Ultimately, though, I think against all of that uncertainty, the world is certainly going in the favor of silver. Not only silver, but also the other metals. I mean, if you take fossil fuels out of the global economy, you have to put something in if you want to drive a car and if you want to have power, right? And that certainly should help a lot of the mined commodities and metals over the coming years. So I think once we see a clearer trend here, I do think that there is scope for further upside on silver and deficits actually in the market.
All right, terrific. So James, talking about silver demand, and we put out a report earlier this year on silver and automotives. We projected it would be about 64 million ounces of silver this year, but we think that's going to grow to about 88 million ounces by 2025. And the reason being is because of the battery electric vehicles, the hybrid electric vehicles, and down the road, autonomous driving. And back to some of the issues you raised earlier, all three of you, regarding government mandates, state mandates, and so forth on the greening of the world and having a less reliance on fossil fuels. Do you agree with the thesis of our report that that silver's growth in automotives, whether it be the internal combustion engine or all the way through to autonomous vehicles, is a net positive for silver?
Yes, I do. We do. HSBC does automotive forecasts. We have growth, outright growth in automotive production over the next several years, particularly in countries outside of the OECD, where the ownership per thousand is still low, and we have growth in hybrids. We note growth in electric vehicles, all of which is going to require more silver, as well as traditional fuel, gasoline and diesel led automotives, because of the electronic component. The silver loadings are going to be higher no matter what auto you look at. And in that case, again, silver is occupying this, not to use the term again, this hybrid space, where it is good for older industries and it is good for the emerging ones too. It's quite unique, I think, in that respect. I can't think of another metal, possibly copper, that occupies that space in that way. And certainly, I think we can look forward to, just simply based on Western experience and projected rises in income in Southeast Asia, Central Asia, the Indian subcontinent, and China, to more automobile demand. Automobile demand, in some cases, is being held back not by a lack of demand for autos, but by road infrastructure and things like that, which is what held it back in the OECD world 100 years ago. And so I think we can, yes, that is going to be one of the shining elements of silver demand going forward, in addition to its environmental applications, for sure.
Excellent.
So if I can look at your numbers actually in tons rather than ounces. So in order that we look at kind of 2020, and we thought we have around 1,600 tons of silver demand from the auto industry, and by 2025 we have that rising to 2,800, just over 2,800 tons. So yes, it is quite a meaningful growth coming through from there. Yes.
I'd like to add to Jim's point. I mean, Jim made an excellent point. There is higher silver content in all vehicles. Pretty much most vehicles now have GPS and sophisticated audio systems, other electronics, just a matter of standard. And there's of course even more of that in EVs and these new hybrids that are coming out. Right now I think we'll have quite a bit of pent-up demand that will be released over the next few quarters, not only because of the recovery from the pandemic around the world, particularly parts of the world, that aren't getting vaccinated right now, but will be in 6 months to 9, but also because we have a global microchip problem that has been slowing down automotive production. So you can well imagine a situation where those roadblocks, those logistical issues get worked out, and we start producing more vehicles, and at the same time, post-COVID recovery helps as well. And the higher loadings because there is more electronic content in those vehicles, just conventional vehicles for now. And we could see quite a spike in demand over the next 6 to 9 months, which could, make our projections of a tight market, despite of potential lowering of investment demand, make silver look pretty good.
Excellent. Speaking to the green issue, once again, are investors making a conscious decision to invest in green technologies over the years? I mean, how many investors are looking ahead to future green demand? And are you hearing from any of your clients on that issue?
Yes, absolutely.
You are, Michael. Thank you.
Absolutely. I think this is becoming, if you had asked me that question 5 years ago, I would probably have said no. I think 5 years ago, talking about ESG and decarbonization was still very exotic. But that really changed, I think, last year, honestly. I think last year we started to see more in-depth discussion about what decarbonization, what tackling climate change actually means. You do see on the investor side that there are dedicated ESG teams out there that do look at some of those trends, and I think those ESG teams were just not in place a few years back. I think you do see increasing pressure put on the energy space to make a bigger contribution to decarbonization. And I think the flip side of all of that is what you're going to replace it with. And I think clearly it would be very nice to have not a net zero emissions, but a zero emissions economy, but that's just not possible. And I think so in the end, I think the global economy has one bullet to bite. And I think from an emissions profile, having renewables, having EVs on the road, which have mine commodities in them, certainly helps reduce the global carbon footprint. And I think it's exactly that angle that makes silver green investment just more important, I think.
Okay, Bart, anything?
Well, certainly we're seeing that not only among investors, but also the corporates. Be that miners or energy producers. I think when some 5 years ago, ESG was getting a cursory look. Now there are actual people dedicated to making sure that they can represent their company as being environmentally friendly. They have targets for emissions. You have a lot of miners saying they will be carbon neutral over a period. There are timelines. Investors are looking at that. Certainly, I think financial institutions as well, they don't want to be positioned in industries that might have stranded assets because of being perceived as environmentally unviable. And I think as we move on, we'll make that more and more of a priority. Of course, the problem is going to be, how do you do it economy-wide, across, never mind across the G7, but globally. You're going to have to involve, all these other people, with major that aren't really doing it quite yet. And there's still a very, very large aversion to nuclear power, which, in my opinion, is going to be required for a full electrification of the economy. And we're going to need, if we're using solar and if we're using wind, for example, we're going to have some sort of storage for base load. So there are a lot of problems. Metals are going to come, I think, are going to be a big solution for it. But I'm not quite sure how that goes. There's a lot of interest, but none of the infrastructure is there, or nor do we have any idea how we're going to do this.
Okay.
Well, I would say that we're seeing the same thing. There's clearly an uptick. I mean, historically, I would compare it to, when universities' endowments seem to be ahead of the curve in many respects. They've been doing this for years. Even it extends to ethical treatment of animals and agribusiness. Or I remember also when the large endowments and then other investment firms started disassociating themselves, say, from countries that had human rights issues, or decades ago, South Africa with apartheid. And I just think we've set up a climate research unit to monitor these things as well within our research function. And I think it was H.G. Wells that said, "There's nothing more powerful than a time than an idea whose time has come." And that's what we're seeing right now, and it's sweeping, and the ramifications of it should not be underestimated by anybody. And fortunately, metals are overwhelmingly on the plus side of that.
Excellent. Well, we are running out of time here. I've just got time for one more question. And briefly, Bart, Jim, and Michael, can you give me your thoughts on the silver market for the rest of the year? And factor in coin demand, if you could, on the physical side in bars, and what you see silver ending 2021 at. Bart?
I think we will get a bit of a rebound in physical demand moving into the second half. I think it's going to be quite apparent now that the Federal Reserve is not tightening monetary policy anytime soon. I think they, wisely made a preemptive strike saying full employment, but not at the expense of hyperinflation. Real rates, in essence, will remain quite accommodative and conducive to investors wanting to position in silver. I think there is concern out there that equity markets might be overdone, and you need an alternative to stabilize your portfolio. Prices where I think we are, a couple of dollars more where we are today by over the next 6 months. I don't think that'll be the peak. I think the peak might be a little later on, but let's say 28, 27.50 or around there is probably reasonable.
All right, James?
Well, our forecast average price for this year is 27.50 with an end of year at 27.80. Coin demand, we're looking for that to pick up, as I think and also bar demand, particularly in Asia, to pick up too, as the lower prices may earlier this year just recently may trigger some more investment. And I would just like to make a quick comment, because if you'd listen to everything we're saying, you'd think silver should be at $30, $40, $50 an ounce, but there is thrifting going on in industry, and I just want to point that out. No substitution of any level really, and also I would remind everybody that on really strong rallies, we may see inventory drawdown, but we're positive. We remain positive. I just want to give that balanced view.
All right, Michael.
I think against the macro backdrop and the uncertainty over greening up the global economy, it's going to remain relatively choppy. But as I said, I think fundamentally the market doesn't look bad. So we have a year-end forecast of 32.50. Should be punchy, but look, we are bullish.
Well, great. Thank you, Bart, James, and Michael, for your participation and excellent insight into the silver investment market. Unfortunately, we have run out of time and will now conclude today's webinar. Ladies and gentlemen, should you have any questions about today or on silver in general, please reach out to us via email at info@silverinstitute.org, or you can call me at 202-495-4030. Thank you all for participating, our panelists and our audience. Much appreciated. Have a great rest of the day.